Alright, let's take a look at some examples of a breakout followed by a continuation pattern. Okay, we are now not going to be trading reversals, we are going to be trading breakout patterns. Alright, well, we are looking now into the Australian dollar against the Canadian dollar weekly time frame. As we can see, price has certainly been uptrending for quite a while, alright, giving us swing highs, swing lows, higher swing highs and also higher swing lows in that trend. Okay, like in any other trend, we can define always an outer trend line, which is what we are going to be doing here. Okay, if we were following this trend in real time, we would obviously also mark swing highs and swing lows. Okay, but and obviously the support points as well. But if we are in a trending scenario, we also need to take a look into the into potential trend lines. Well, eventually, like in any other trend, that trend line, well, gives way, that trend line loses momentum, and we see a breakout there. Okay, let me now zoom in a little bit more just to make sure we have a clearer picture. All right, there we are. That's the breakout that I was just talking about before. And again, like I say, any trend line eventually gives way and eventually gives us a breakout opportunity. Well, maybe I zoomed in a little bit too much there. All right, so we do have that breakout. Please take a look at the breakout bars. Actually, the breakout here happens somewhere in between two different candles, but at any rate, please mind the nature of those candles. Long candles with long bodies. Do you see that? Long candles with long bodies. That means these moves, the breakout moves, are happening in momentum. All right. What do we get right after? 1, 2, 3 bars coming back to retest breakout points. All right, the breakout point is obviously the level of support and resistance in itself, the trend line. Right, up on the breakout we have 1, 2, 3 bars coming to retest right to the pip. All right, right to the pip, that particular level, and from there what do we get? A twin pin bar. Right, a twin hammer formation, and you guys know how to treat that. That usually signifies that a reversal is about to come through. Right, it's about to, we are gonna get an imminent reversal price action in the upcoming bars. So not only we have a breakout in momentum, okay, not only we have those 2 or 3 bars coming to retest breakout points, we also from that get our a typical reversal price pattern, and from there what do we see? 1 and 2 bars to the downside. All right, entry right there, stop loss 50% of this bar, somewhere in there. Came close. It came close to touch that level, but it didn't. First target in there as that bar closes, 50% of the trade, and then 50%, the remaining 50% of the trade down there. All right, very typical breakout, pullback, bounce price formation. All right, a breakout, a little bit of a pullback to retest that level, and we get the bounce, 1, 2 bars in our direction, easy peeps there. Alright, let's take a look at another example. In this case, the sterling pound against the Swiss franc on the weekly time frame. Right, price gives us a final. Actually, let's zoom in a little. Let's zoom out a little bit more. Price gives us this double top there, this double level of resistance. From there, price begins to trend down. Okay, our job as a trader, again as usual, is to mark the major swing highs and swing lows. Again, like I say, we get a major full swing to the downside. Eventually, price gives us a support point and also a resistance point in there, which is actually some sort of a double top in there, right? So we prolong support and we prolong resistance. Price next time that comes to retest that level actually respects that particular level, and well, we can assume that price has entered some sort of a range. You see that how price has been ranging. All right, oops, sorry about that. Actually, let me mark it within a straight line, with an actual trend line there. All right, so price has been ranging. All right, move, range, and then we are waiting for price to reach again these levels of support and resistance in order to get some type of market reaction, don't we, as usual? Well, Next time price comes to retest that level, what do we get there? Actually, let me zoom in, as usual, a little bit more. Alright, there we are. Now let me extend that particular line. Alright, and now I am also going to mark the top, right? The top of the range there. So this is the range I was mentioning before, coming from above. Price ranges, consolidates for a little while. Next time price comes to retest that former level of support with that double bottom, what do we get? A full breakout, a momentum breakout. Again, very important, long breakout candle with momentum. Small wicks both up and down. That signifies that that breakout is happening in momentum, and we should be ready to search for continuation moves. What do we get after the breakout bar? A small bar. You see that small congestion bar? By the way, this is a if you haven't guessed yet, this is the standard breakout congestion continuation pattern. All right. Again, breakout in momentum, small bar, congestion bar. All right. We mark our, or we set our sell stop at that point. Stop loss right above there. We get triggered in the next bar as usual. Also, please notice how the continuation bar, right? This. Let me zoom in just a little bit more. I really want you guys to see this. Okay, do you see how this continuation bar is more or less equal in size as or equal in length as the breakout candle? This is usually the norm, all right, on a breakout congestion continuation pattern. The continuation bar is usually more or less equal in size as the breakout candle in itself, all right? So as you can see, more or less the same length in there. Anyway, like I say, we base our entry around the congestion bar. That would be our entry, that would be our stop loss, that would be our first target, and as usual, we get usually momentum enough for 2 bars in a row. Okay, that's the close of the second candle there. Pretty typical breakout congestion continuation bar, pattern. As price breaks free away from a congestion area. Please remember how I was mentioning on the previous presentation, on the previous video, how these type of formations are very typical as price breaks away from congestion areas. My favorite, again, are leaning triangles, or what I call flat bottom triangles. Okay, if these more or less took this shape, that would have been ideal, right? If price more or less was something like this, that would have been ideal. Again, because price builds up pressure up on this particular level, and eventually it gives way in momentum. That's my favorite type of setups. But standard ranges, sideways ranges is still very valid, all right? And as you can see, we can indeed find that breakout congestion continuation pattern again as price breaks free away from that congestion area. All right. All right, let's take a look into the sterling pound against the New Zealand dollar monthly time frame. As you can see on my screen, price has been, well, ranging, zigzagging up and down for quite a while. We can certainly define or easily define the ranges, the boundaries of that range, okay, with multiple resistance points to the upside and also support points to the downside. All right. Anyway, last time price came to retest either of those particular boundaries. I'm talking precisely about that point. Let me mark that with a trend line. Right there. Now let me zoom in a little bit more. See what type of market reaction did we get? Did we get a reversal? No, we didn't. Did we get a breakout? Yes, we did. So we know how to act here. If we get a breakout, did we get a breakout congestion continuation pattern? No, we didn't. We got the breakout, we got the continuation, but we never got any type of congestion or sandwich bar to base our entry around that level, right? So we couldn't take that trade. Did we get a breakout pullback bounce setup? Well, for the time being, not quite. We've gotten the breakout, driving price far away from breakout points. You guys see that? How these two breakout candles, momentum candles, again, momentum, full, long, solid breakout candles. I like to see that. Well, we see how these two candles drove price rather far away from breakout points. And now, well, did we get two or three retracement candles back to breakout points? No, we didn't. Price has stalled at the bottom of this breakout thrust. So basically what we are having is a breakout, and then, well, price simply meandering sideways from that point on. Courses of action here, since we didn't get the entry on the initial breakout, well, I am afraid that the only thing we can do now is to wait for a full swing reversal. Full swing in their search for a reversal formation there. For example, well, a swing back to retest that level, and from there, well, expect to see either a pin bar, right, or a railway track, all right, or, well, you know, outside bars, or any of those patterns that we mentioned on a previous video. But like I say, we didn't get either of the two initial breakout patterns. Now the only thing we can do is to simply wait for a full swing, and from there reversal, searching for a bounce, for a continuation trade in the direction of the original breakout. Alright, let's take a look at another recent example of a breakout and continuation pattern. New Zealand dollar against the Canadian dollar, weekly time frame. As I scroll back just a little bit in time, we can see how price began swinging up, okay, basically giving us the basis for a healthy uptrend, okay, higher swing lows, higher swing highs, you know, and our job as a trader is just to keep on drawing levels of support and resistance as the trend develops, okay, and obviously trend lines as well. Obviously, as price comes to retest those levels, we are going to be searching for our particular patterns. All right, for example, take a look at what's going on there. Breakout, congestion, continuation move. Do you see that, guys? Again, I repeat that. We have a swing high, a resistance point. We draw the horizontal level of support and resistance, breakout, congestion, continuation move. You know, pretty valid trading opportunity. But anyway, let's mark the trend and wait for another breakout. Just let me extend that line, you know, up on the onto the future. Okay, just a little bit more. Yeah, I'm sure you are already seeing with your own eyes what I mean here, okay? So eventually this trend that's been going up for a little bit, for quite a bit actually, quite a few swings, that's given us a breakout pullback, a breakout congestion continuation opportunity there, eventually comes to retest this level of support, which is that outer trend line in that trend, okay? Do you see from the beginning of the trend linking to that swing point, and well, also that one there? Well, we have the outer trend line for this trend. Price comes to retest that level once again. What do we get? We get a breakout, don't we? So we have, as a breakout, we have three different patterns that we can trade. You've already seen that on a previous video. Price drives the breakout drives price away in momentum, and then what we see is 1 and 2 bars coming back to retest breakout points. Breakout points, obviously that trend line, and at that point what we get is our typical you know, faithful hammer formation that, you know, so often gives us valid trading opportunities right off that level of support and resistance. Former support, once broken, it works as resistance, and from there, well, we get one momentum bar, and then the second one is rather small. We wouldn't have gotten, you know, any spectacular, so to speak, profit out of that second move, but nonetheless we certainly made some good pips on the first one, okay? Again, breakout, 1, 2 retracement bars, so pullback bars, eventually giving us the pin bar, the hammer formation, and from there, well, we profit from the continuation move. Alright, now I would like to show you guys one setup that I actually have on my own personal watch list. Well, you know, a trade that I am looking to trade as soon as the opportunity comes. In the New Zealand dollar against the Swiss franc, weekly time frame, as you can see. The reason of why I want to show you this particular setup is because we are seeing what I call a flat top triangle, and as you know, it's my favorite, one of my favorite setups. All right, it's some of the setups that usually give me the highest win-loss ratio in my trading. And well, as you can see, price simply was gave us a nice swing up, all right, and then it entered a period of congestion, and that congestion area is taking the shape of a flat top triangle. We have a key level that's remaining flat. Basically, price is finding flat resistance at that level, whereas we are also getting a diagonal level of support, basically a trend line, as price is certainly pulling higher swing lows. So as you know, this signifies that, or means that price is simply building pressure up on this particular level, and my course of action obviously is to wait for a breakout in the direction of that flat line, of that flat level. If I got a breakout to the downside, well, things usually get a little bit uglier or not so accurate whenever the breakout takes place in the opposite direction. I always like to see this breakout, okay, again in the direction of that flat line. For the time being, obviously I cannot take any trade because price is still entrapped in this no man's land. All right, as you guys know, I don't like to trade within the traffic. All right, in no man's land, I like to wait for actually price driving away from that congested area. Okay, but like I say, fantastic opportunity, flat top triangle. I love them. Whenever I see them, I am all over them, waiting for well, for that beautiful breakout, hopefully happening to the upside. Alright, now let's take a look into what a full swing reversal actually looks like on a forex chart. We are looking into the American dollar against the Japanese yen, monthly time frame. Actually, I may need to zoom out a little bit more in my. Oops, way too much. Just right there is about enough. Okay, in this chart we can see how there is a key level of support with that double bottom support there, and also price has been scoring lower. Well, lower swing highs. So effectively what that gives us is one of my beloved flat bottom triangles. All right, price building pressure into this horizontal level of support. So I am going to mark just that on my chart. There is no need to mark this one because eventually the breakout got or happened to the downside. Anyway, let me here we got a little bit of a fake breakout, okay, a little bit of a fake breakout, and eventually the breakout, the real breakout, happened there. Please mind, as usual, the nice momentum breakout there. Okay, anyway, price comes back down in a full swing, all right, in the direction of the latest trend, which is to the downside. Okay, we can set, oops, we can define an outer trend line there, okay, which so far is being respected. Okay, for the time being, so far so good. Anyway, so we got a swing down, and then we need to wait for a full swing to retest that former level, all right, of resistance, with that, again zooming out, with that double bottom of support. Okay, that one there, and then that one there. Okay, so full swing down, full swing up. What do we get once price comes to retest that level? We get a one of those ugly dojis that I personally don't like to trade. When I mean these dojis with long wick both up and down, that's from a money management very ugly to trade. But imagine this was a valid doji. I mean, this was a doji with a small body and small wicks both up and down. All right, imagine this was not one of those ugly dojis, but it was actually a valid one. Well, that would have been an ideal reversal swing pullback, full swing reversal formation. Okay, you see the full swing eventually leading to the reversal right off that former level of support and resistance, and from there, well, down it goes. Okay, again, shame on this one. From a money management point of view, makes it very tough to trade, because if that's the entry and that's the stop loss, as you can see, by the time you get your entry on the following candle right there, your entry is just so far away from your from your entries. It's just not worth it. All right. Other than that, perfect example of what a full swing reversal actually looks like. Please note how we are trading reversal formations, again assuming that was a valid doji, how we are trading reversal formations to trade in the direction of the ongoing trend. Let me zoom out a little bit. Okay, of the ongoing trend, and always in the direction of the original breakout. Alright, we are not now trading reversals as we were trading before, such as like that, okay, against the direction of the previous move, and not getting any breakout whatsoever. This time around we are using those reversals in order to trade in the direction of the market bias and also in the direction of the breakout. Alright, let me now show you another example of what a full swing reversal actually looks like. We are looking into the American dollar against the Canadian dollar, monthly time frame, and as you can see, price has certainly been going through a downtrending, downtrending price patterns. Alright, nice swings to the downside, obviously scoring lower swing highs. Alright, and lower swing lows, etc., etc. Basically a downtrending scenario. What are we to do as support and resistance traders in a downtrending scenario? Well, we mark levels of support and resistance with each consecutive swing, right? And obviously also the trend lines. So we have the trend line there. We have our levels of support and resistance on this last swing. Price comes to, let me actually zoom in a little bit more. Alright, there we are. Price comes to, up on this last swing, we mark levels of resistance and levels of support. There we are. So, as I was mentioning before, price comes to retest this former level of support. Do we get a reversal? No, we don't. We get a breakout? Yes, we do. If we find a breakout, do we find any of our two immediate breakout patterns, meaning breakout, congestion, continuation, or breakout, pullback, and bounce? Do we get any of that? Not really, we don't. Simply price drives away, okay, takes off in a whole new swing to the downside in the direction of the trend. We simply didn't get any suitable entry point upon the breakout. So what are we to do? Well, I am afraid we need to wait for a full swing pullback, right? For a full swing pullback, just to see if once price retraces to the any level of resistance, we get a reversal formation. All right. Effectively, what I'm doing here is searching for my typical full swing reversal pattern. So I need to extend my level of support. All right, because once broken. Whoops, sorry about that. Once broken, it may act as resistance. All right. So price takes off. Let me zoom in a little bit more. All right, there we are. Price breaks out, gives us a whole new swing. We missed that any type of entry. We just didn't get any pattern in there. So we need to wait for a full swing retracement for price to retest former levels of support. Let me be accurate with my trend lines. Okay, right there. And eventually price does come back to retest that level. In fact, if you pay close attention, not only we get a hammer, right? A reversal pattern right off that level, but in fact what we get is a fake breakout formation. All right, you see how price seems like it's going to break through, and immediately after it comes back down to close to close below that level. That's not only it's a reversal, but it's also a fake breakout. At the end of the day, you need to remember that a fake breakout is just a reversal disguised in the shape of a breakout or a fake breakout. Okay, but the nature of a fake breakout is indeed a reversal. Not only we don't get the breakout, eventually price turns around, gives us our entry there as per the fake breakout strategies. All right, gives us our entry there, stop loss somewhere in there, first target, second target, etc., etc. All right, but anyway, what I want you guys to pay attention here is how we got a reversal at the end of the full swing. All right, at the full swing pullback, that's where we got our entry in the shape of a reversal or a fake breakout. Again, they both work in the same way. Hello there, welcome back. Once again, Hector Davil. In this video, we're going to be talking about limit orders and how they can help you getting tighter entries. Okay? So far, what we've seen is, as far as taking our entry goes, we would wait for a price to break beyond the actual reversal candle. To be more exact, 5 pips beyond that candle in order to trigger our entry. Okay, regardless of whether we were searching for reversal formations, okay, in the shape of, I don't know, a pin bar, or in the shape of a railway tracks, or even a fake breakout as well, okay, fake breakout formation, right, with that wick breaching through the key level of support and resistance, even in continuation patterns, okay, always we would, so far what we've seen is to set our entry just above, all right, just beyond that key bar, that key candle that we use for our entry. Okay, for the sake of simplicity, I'm gonna go back into our typical pin bar formation just to explain things here using this example. But again, you can apply exactly the same concepts on any different formation any of the formations that we've seen so far. All right. So as I was saying before, what we've seen so far is to simply take our trade 5 pips below the low of that particular candle, either waiting for price to actually move back down, okay, on the trigger candle, this one here, and simply click on our sell button there, manually click on our sell button, or as an alternative, wait for this candle to close, let's assume, I don't know, in there, and then go ahead and place a sell stop order at that particular level. A sell stop order, as you know, is a pending order at one specific level that you predefine. Once price hits that level, your broker will execute your sell order and you will be effectively filled in the market, or again at that predefined level that of your choice. Well, now I'm gonna offer you a different approach, or let's say an alternative, and that's using limit orders, which is also a pending order. Okay, basically an order to instruct your broker to execute you in the market or into the market at a price level different than the actual current market price. Okay, when you click on your buy or sell button, when you manually click on your buy or sell button, your broker executes you right there, all right, at whatever the current market price is. All right, when you are using a limit or a stop order, it's just an instruction to tell your broker, hello, I want to be involved in this market, but not at the current market price, but instead at this or that market, at this or that price that you predefine. All right, that's basically what a pending order is. In case you don't know the difference between a stop order and a limit order, there is a fantastic resource link under this video. You can click on it, read the article. It's going to explain all the difference between a stop and limit orders. Again, both of them are pending orders. There's just a small difference in between. Like I said before, now we are not going to be using stop orders, we are going to be using limit orders. Okay, so you may want to just read that article and then come back to this video. Anyway, assuming you are already familiar with limit orders, like I said before, we are going to use them in order to squeeze tighter entries in our trading. Okay, basically we are going to get ahead of the market, try to jump into the trade a little bit earlier and therefore at a better level. Okay, obviously that's going to carry an extra degree of risk whenever you are getting ahead of the market, whenever you are not waiting for a confirmation. Please mind that whenever we were using stop orders there, we were waiting for the confirmation of the breakout of this candle before triggering our entry. Well, now we are not going to wait for the confirmation, and obviously if you don't wait for the confirmation, you are getting into the trade ahead of the market, and that always carries a little bit of risk, all right, of extra risk. So limit orders is just a little bit of an aggressive stance here. It depends on whether you are an aggressive or a conservative trader, but I just wanted to, give you the opportunity to choose by yourself, all right? So the basic idea here is as soon as price this candle closes, let's assume it closes there, instead of placing our sell stop order there, we are going to place a limit order above current market price. Basically what we want to take, or we want to enter our short entry at a higher level. Obviously the higher we take our entry, the better, because once price begins to run down in momentum after this reversal, well, we are going to be making this much of profits instead of this much, all right? So, or this many pips in profits instead of this many. So again, our goal here is to get as soon as possible into the trade so we can run for further profits into that trade, all right? Now, as this bar closes there, the question is, how early can I get into the trade? Or what's the same, how far up can I push my my limit order? Okay, and the thing here, I mean, the real risk here is that if you push your limit order too far up, you may incur into the risk of actually missing the trade altogether, because price may never come all the way up there to touch that particular level, and if it doesn't, your broker will never execute that order for you. All right, please mind that a pending order is only executed if price touches that particular price level. So if instead price, let's assume you place, actually let me just draw an actual horizontal line, all right? That's supposed to be as price closes there, right? That candle, we go ahead and place our limit order, which is signified by this line. Let's assume you place it there at that price level. Well, in this case, as you can see, price never retraced up in this particular candle, the candle that's meant to trigger our entry, right? It never came all the way up there, and therefore our broker never executed that order. Price simply went all the way down, okay, in our desired direction, and since our order never got executed, it just remained pending in the cyberspace, or in the back stages of the forex market, but it never actually gets executed. So you are never short. You actually never get short into this market, and therefore you miss this opportunity altogether. All right. So the question remains: how far can I push this limit order safely, or safely enough to have a high chance that it's going to get triggered in this bar? Well, in my experience, 33% of the actual candle that we are using to base our entry around, in this case meaning the pin bar in itself, well, you measure the entire range, and like I say, 33% of that range, of that total length, let's assume somewhere around there, you can safely place your limit order around that level, and more often than not, again, in my experience, 80% of the time, that level is going to be hit, all right? In the following candle. Usually you see a little bit of a retracement, like I say, enough to hit that 33%, and from there, well, obviously, at that point, your broker executes your order, and then you are effectively short. So you make sure that you do not miss any potential down move that you may get from that point on. The absolute maximum I would push my my limit order would be the 50% of that entire range. All right. The absolute maximum, somewhere around there, 50% of this entire range. That's, again, the maximum. If you push it any farther above, then chances are you will never get hit. I mean, not you, your limit order will never get hit, and therefore you will never be riding that potential down move. Okay, so anything between 30 to 50% is usually okay. All right. not certainly nothing beyond the 50% level. My advice, guys, just leave it at 33%. That's a rather sensible, reasonable level to place your limit order. Just 33% is more or less around there. It's usually a rather conservative and like I say, reasonable level to place your limit order. Now, obviously, before, whenever we were entering using a stop order there, we were placing our stop loss at 5 pips above the 50% range. Remember that? Well, now we can't do that because we cannot take our entry at the 33% level and then place our stop loss at the 50% level. It's just too close. It's just too close. If you tighten in your stop loss so much, so sharply, so closely to your entry point, that's asking for troubles. Any random wiggle in the chart, in the price, is gonna knock you out. It's gonna hit your stop loss and knock you out. So the idea here is you take your entry with a limit order at 33% of the bar. Okay? You place your stop loss right there, 5 pips above the high of that bar. Okay? And once price begins to trail down, begins to drop back down into this level, okay, 5 pips below that level, then you trail your stop loss from its original location down to either the 50% or the 33% if you want to be a little bit more aggressive with your stop loss management policies. Okay? But at any rate, recapping a little bit, entry right there with a limit order at 33%. You place your stop loss just above that particular level. Okay? Assuming price does indeed from this point, all right, from the closing point, retrace all the way up, you get hit, you get executed into the market, and from there price begins to move down, which is usually the case. Well, once price ticks below the low of that hammer formation or any other candle that we were using in order to trigger our entry, okay, once price comes down there, you simply go into what we saw on previous videos. Once price is down there, you trail your stop loss down to, again, either 50% or entry level, meaning the 33% of that range, of that bar length. All right, that's entirely up to you, depending on how aggressive or conservative you want to be with your money management. With your stop loss management policies. Both options are equally valid. Both options are equally valid. All right. And as far as the profit-taking level location, everything remains the same. You close 50% of the trade at the close of this bar. All right. At that point, if you hadn't done so before, well, at that point you trail your stop loss to break even, and then simply let the second portion of the trade run to further profits, if the market so wishes. All right. But like I say, you take your chances and leave 50% of the trade remaining or open in the market for potentially for further profits. And that's basically it, guys. That's pretty much all as far as limit orders. Like I say, just another option as far as entering the trade. Again, a little bit more of a riskier approach than simply waiting for a stop order beyond the candle, the actual candle. But again, sometimes it's worth it taking a little bit of risk, taking an aggressive stance, because you can really get or improve your entry significantly. So, okay, I mean, if you were to locate it at 33%, which is what I advise, of the previous bar, again, somewhere around there, I mean, take a look at, take a look at how much you actually gain. Being conservative using a stop order, this is what you would, no, actually, if that's your entry and that's the close of this bar, this is how much you would gain being conservative, meaning using the stop entry order, the stop pending order. But if you use a limit order, okay, instead of entering here, you enter up there and check that out. I mean, it's almost double as much. All right, almost double as much. So My advice is that you experiment a little bit with limit orders. It's usually worth it. Okay, it is indeed usually worth it if you don't mind, that little bit extra, extra touch of risk in your trading. Because again, you can certainly bump up the profits on that first candle. All right, on this first trigger candle. And that's it, guys. Again, experiment a little bit with limit orders, and that will sharpen up your entry quite a bit. See you in the next video. Bye-bye. Hello there, Hector Deville here. Welcome to a new video, actually to the last video of the part-time trading module. Alright, congratulations, we've come to an end. Now it's time to wrap it all up. Alright, just review very quickly all the process as far as part-time trading goes, and well, from thereafter it's all up to you. It's time to get your hands dirty with actual trading action. Anyway, as I was saying before, it's time to wrap it all up, and well, I guess we need to start off with the most important point of everything we've seen throughout the entire module, the weekend market analysis exercise. All right, those 30 or 40 minutes you spend on Saturday or Sundays, whenever the markets are closed, in order to define those key levels of support and resistance on the 28 major currency pairs on the daily, weekly, and monthly time frame. All right, that's mostly where the majority of the workload is gonna be done throughout the week. All right. Again, 30, 40, 45 minutes, no more than that. From that point on, well, simply check your charts for just 10 minutes a day. You don't need more than that, okay? Ideally, the time you want to check your charts is exactly at the time where your forex broker closes the candle for the day, right? Closes the daily candles. Every different broker, depending on where in the world they are located, well, they close their daily candles at a different time. Some brokers define the end of the day as per GMT parameters, or as per London time parameters, or as per New York Eastern Standard Time parameters. It depends. All right, it depends. Try to get a broker that more or less fits your time schedules. All right, and well, around that time, whenever they close the candle, please mind that all the strategies, all the patterns we've reviewed on this module require the candles to close. That's why you just want to, for example, let's assume your broker closes the daily candles at 5 p.m. Eastern Standard Time. Well, you want to sit at your trading station from 5 p.m. to 10 minutes past 5, alright, 15 minutes past 5 p.m. Eastern Standard Time, around that time, just to make sure that the candle for today has closed, and therefore you have all the information that, well, you require for your trading, alright? Now, your job as a trader during those 10 minutes that you're going to sit on your trading station every day is very simple. It's just to confirm whether price has hit any of those key levels of support and resistance that you predefined over the weekend market analysis. If none of the charts that you have open have hit those key levels of support and resistance, no problem, just shut your trading station down and come back tomorrow, right? There is no need to rush into things. Basically, wait for price to hit those levels, and then it's all about seeing or monitoring price action. Basically, what I'm talking about here is, do you recognize any of the patterns that we've been studying throughout this video? Either a bounce pattern, or a fake breakout pattern, or a continuation pattern, a breakout pattern. All right, those are the three types of patterns, and well, as soon as price hits any of those levels, simply zoom out into whatever time frame you should be zooming out, depending on whether that's a daily level of support and resistance, a weekly level of support and resistance, or a monthly level of support and resistance. All right. Let's assume it's a weekly time frame level of support and resistance. All right. Well, simply zoom out into the weekly chart and just wait to see whether you recognize any of those patterns. Do you? If you don't, if price is not giving you the market reaction of that particular level of support and resistance, any market reaction that you actually recognize, again, come back tomorrow. Don't rush into things. Just let it go. Come back tomorrow. See if you see things more clearly tomorrow. If you do, if you get any of those beautiful hammers, any of those, I don't know, railway tracks, any of those, breakout, congestion, continuation patterns, any of those patterns we've seen throughout this module, well, then move on to the next phase, the next stage. Place your stop or limit orders. All right, just place your entry levels, your pending orders, set your stop losses, all right, your stop loss level, and that's about it. Your job as a trader is done. Now you can simply walk away and come back tomorrow, also again for another 10 minutes, in order to manage the trade. All right, can you trail your stop loss to break even? Can you close 50% of the trade at the close of the following candle? Etc., etc. Obviously, if that pattern, that you are actually trading is on the weekly time frame, well, obviously you will need to wait for a whole week in order to, well, take a decision as far as managing the trade. Remember that we only take decisions at the close of the candles. So, if you are trading off the weekly time frame, you need to wait for a whole week. All right, until the next bar actually closes, and then you take a decision. Do you trail your stop loss? Do you exit a portion of the trade? Etc., etc. All right, and then simply start all over again. All right, again every weekend. Draw or redefine, readjust those key levels of support and resistance on your charts, and from then on, just keep on following this part-time trading routine, sitting at your trading station for 10 minutes. That's the beauty of trading the long-term charts, guys. There's no stress, just 10 minutes at your own pace. No need to take trades every day or every week. Again, 2 or 3 good trades a month is more than enough, all right, to grow your account over time. And that's about it. It's basically fitting your trading around your lifestyle and not your lifestyle around your trading, which is usually what happens whenever you decide to become an intraday trader. Trust me if I say that, unfortunately, rather unfortunately actually, intraday traders have their daily habits, their daily schedules built around or organized by their intraday trading routines. All right, their intraday trading routines dictate when they can take a lunch break, when they can go out to pay a visit to a friend, etc., etc. The beauty here is that none of that is going to happen to you as a part-time, long-term trader. You are going to be in control of your trading. You are going to be in control of your trading times, and therefore you're going to be able to compatibilize. Is that even a word? Compatibilize? I don't know. Anyway, you're going to be able to compatibilize your forex chart with and your forex trading with your day job, your family commitments, your hobbies, okay, and your leisure time, etc., etc. Anyway, folks, that's all about part-time trading. I hope you enjoyed this module. As I mentioned before, now it's all up to you. It's time to, again, get your hands dirty, get to work with those weekend market analysis, with those key levels of support and resistance, with recognizing or searching for those reversal or breakout patterns around those key levels, basically price action reading around those key levels. And once you master it, trust me if I say, it's a fantastic method, all right, a fantastic way of trading the forex market without spending all your day glued to your to your computer, to your screen 24/7. All right. Okay, that's all for now. Bye bye.